Tonight, Rob is here to discuss, as he always does, the state of the market in his own inimitable way, the state of the market at large, and the many developments of McEwen Mining in particular. Please join me in welcoming Rob McEwen.
Thank you, Victor. I don't know how I'm going to deliver on what everybody said. First Eric, then Victor. But good evening. I'd like to start, since it's been put in place, with a little bit of history. And this is GoldCorp from 1993 through to 2005, compared against Berkshire Hathaway and Microsoft. Microsoft in red and Berkshire Hathaway in blue, and you can see they did very well in that 13-year period. But GoldCorp did a little better. And I believe that the mining industry, I grew up in the investment industry. My first 18 years were in the investment industry, focused in the mining area, doing a number of jobs from research to sales to investment banking, owning a major stake in a Toronto Stock Exchange member firm. And I thought, I'm dealing with intangibles, and I'd like to see if I could build something I could touch. And the mining industry, I suppose the investment industry is similar. Not quite. The mining industry has this very interesting aspect to it, that there is a possibility of hitting a home run, clear out of the park. The probability is very low, but I wanted to jump into that flow and see if it could happen. And GoldCorp came along. I bought a mine that no one wanted, or few wanted. They thought it was at the end of its life. And a mile below surface, we found a gold deposit. This is a mine that was 50 years old already. And we found a deposit that has become the richest gold mine in the world. And I've watched discoveries being made in the industry, and I know there'll be more made in the future. I stepped out of GoldCorp in 2005. It had grown to a size that it was becoming more cumbersome. The compliance issues of the New York and Toronto Stock Exchange were dragging down our board. Board meetings went from 1 hour to 3 hours, and they dealt with, have we checked all these items off the list? It was all about covering your ass. And I said, gentlemen, this is all about, when you're running a public company, making money for your shareholders. It's not about covering your ass. And so I said, it's time for me to step out. But I was hooked on the discovery cycle. And I said, well, let's see if we can do it again. Let's get like Ben Franklin and go up on a hill and send a kite up into the sky and see if we get hit by lightning again. So, as Victor said, in January of this year, we merged two companies to create McEwen Mining. Would like to say, Eric said a lot of kind words. I've known Eric for many years. I have a great deal of respect for him. He's someone who does a lot of intensive research. When he decides on his course of action, he commits with both feet, and the conviction he has, he just pushes forward with it, and he's been very successful doing that. And he's very worthwhile listening to, and as you heard today, he goes into a subject in great detail. So, mining can deliver a lot of wealth if it's packaged properly. Now, there's a safe harbor statement, cautionary statement, so you have to ignore everything I say. But let's start off. What you need to understand, if you're not there already, is that gold is money. It's a currency, much like dollars, euros, pesos, yuan. But it has one big difference. It's the ultimate currency. Now I'd like to show you a slide. I've often shown a slide showing from 2001 how much gold has gone up in various currencies. But Eric talked about the loss of purchasing power. And that's what this graph is all about. If in 2001 you had elected to put your money into gold out of the currency that you held it in, and then you look back today at how that currency did against gold, you would have seen how much loss of purchasing power you would have experienced. So if you kept your money in Australian dollars, you'd be down 69% relative to gold. If you kept your money in US, in the dollar, you'd be down 86% in only 10.5 years. Why is this happening? It's not just Washington, it's Brussels, it's Ottawa, it's every capital. The central banks are incurring more and more debt. So what we're looking at here from April 01 to present, this line is showing the gross national debt of the United States. It is now above $16 billion. And in February, the Office of the White House put out their budget, and their forecast for 2022 is that this number will be $26 billion. Now, I'm sure you'll all agree that most politicians miss on their estimates and go over that, because they're always looking to increase their debt levels in that. This number is going a lot higher, and when you look at this line between 2001 and 2008, it's going at the slope of the line is shallower than from 2008 to present. Well, just looking at this from 01 to 08, the slope of the line is 25 degrees. From 08 to present, it's 55 degrees. It's starting to take on a look of an exponential slope. This is the price of gold, and it's tracking it very closely. And I'm going to suggest to you that correlation is not going to change. And the debt level is going higher. Some people have said, well, gold's not a good investment, and certainly in the 70s, when interest rates were higher, people could argue it costs money to hold gold, and there is a real opportunity cost because you could earn interest on your money. And Paul Volcker came in as chairman of the Federal Reserve, and in the late 70s, early 80s, he just pushed up interest rates and killed inflation. But we had Fed fund rates approaching 16, 17% before this market in gold stopped. Right now, if you look at the right-hand side of this chart, interest rates, as you know, if you're trying to earn any money on short term, close to zero. And the gold price is just under $1,800 an ounce. There is a lot of room. So this is the lowest in terms of the last half century. This is the point where gold has the lowest cost, opportunity cost we've seen in the last 50 years. So no opportunity cost to own gold. Why don't you have more of it? This graph I've always enjoyed because it shows, and I'm a big fan of economic history, big student of that, but it's showing over the last 116 years the cycles, the big economic cycles that have occurred in our economy. And it's taken the Dow Jones and divided it by the price of gold. So back in 1896, 1 ounce of gold bought the Dow. 1929, it took 18 ounces, and 3 years later, it took 2. And you can see these cycles. The top of the high-tech market in 1999, it took 44 ounces to buy the Dow. Right now, we're at 8, and I'm going to suggest to you it's going back down to the baseline of 1 or 2 ounces buys the Dow before we're out of this gold cycle. I believe gold's going a lot higher, and before the cycle's over, we're going to see $5,000. And if you believe that gold is going higher, we've seen that gold equities right now have underperformed gold by a significant margin. And to me, on a relative basis, that suggests that you should be looking at gold equities today. One chart, it's courtesy of Bloomberg and a brokerage firm in Canada, CIBC World Markets. They looked at the presidential election years from 1984 to 2008 and created a composite graph of how the XAU, or the Philadelphia Gold Index, performed during each year there was an election, created that composite, and then looked at the year after and saw that the gold index, and there of the senior gold producers, performed very poorly during the election year, and it recovered all that it lost in the following year. And to me, that's very intuitive, and as Eric was saying, the numbers coming out from the government, maybe they're pushed in one direction so that the incumbent looks more attractive and can be re-elected, and the press is distracted from what's going on in the market and focused on who's going to win the election and what have they said and not said. So if we go back to this graph, this divergence between the gold price in gold and the gold stocks in green is at a historic level for the last 12 years. And part of it could be explained by this phenomena that happens every 4 years. And so you should start thinking, I believe, about buying some gold stocks. Now, the senior gold stocks have had horrible performance since May of '06. And I picked that because when in 2005, I stepped out of GoldCorp after running it for 19 years. I bought another company and merged it with GoldCorp, and I said to the management of the company I bought, you run this company. And I was quite convinced that GoldCorp, I said to our shareholders when they voted on it, we'll get a double or a triple in 12 months. The company I bought was trading at 1 times NAV. It produced the same amount of gold as we were producing, 600,000 ounces, and it also produced copper, and copper represented 40% of its revenue stream. And I said, we're going to see an increase because there are 2 companies out there, McEwen Mining and Placer Dome, that also have 19 and 17% of their revenue coming from copper, and they're trading at better than 2 times NAV. So when you put GoldCorp and Wheaton River together, the 40% copper of Wheaton turned into 20%. And I said we should be accorded the same multiple or more. And GoldCorp was trading at 2.5 to 3 times NAV at the time. So it didn't take 12 months, it took 14 months, but we had a triple. And that was on May 10th, 2006, 14 months after we put the companies together. But since that time, the majors have just put in awful performance. In the past, everybody believed if you increased your production, increased your resources, your share price would go up. So we look at Kinross and GoldCorp, their production's up around 50%, and their share price barely moved or negative. The best performer in this group is Barrick, and it's up just under 10%. At the same time, gold's up 150%. And they've all increased their dividend yields. So they haven't shown leadership. So now I'd like to talk about MUX, which is McEwen Mining, the stock symbol for the New York and Toronto Stock Exchange. And why is it special to me? First of all, my cost base for my investment is $110 million. I didn't get any stock for free. I put this money up to buy my interest. I own 25% of the company. And I believe that the CEOs have to have an interest in their company, and that's one of the reasons why these guys haven't performed, because they have almost 0% interest in their companies. And they don't wake up every morning thinking, I have to do something to make my share price increase. It's more, if I merge with someone, I'll get a bonus. And I'll keep a higher salary. So what do I like about this? First, we have some production growth. By the end of 2015, we're projecting a tripling of our production. I put it all in gold and gold equivalent, but we do produce gold and silver. So we'll be going from about 100,000 ounces to just under 300,000 ounces. So if you're looking at resources, McEwen Mining has a number of assets. So if you're like Dandian Resources that had a property in Argentina that was bought out by GoldCorp for $3.6 billion, we have property, a mine right next door to that, and we surround GoldCorp's property on 3 sides. Argonaut Gold is an active producer in Mexico, and our growth profile is the same as theirs. And we also have a large copper project, which is slightly smaller than Lumina's Copper's project, but at a better grade. So, if you buy resources, companies with a lot of resources, this is our resource base based on a Canadian National Instrument 43101. So we have 7 million ounces of gold, 205 million ounces of silver, and 15.4 billion pounds of copper. So if you were to put that on a gold equivalent basis, that would be equal to 1.6 ounces of gold equivalent per share of McEwen Mining. Our assets are through the Americas. We have a producing mine at the bottom of the screen called the San Jose Mine, the bottom right. We own 49% of it. It produces just under 200,000 ounces of gold equivalent. We're just started one of our 2 mines in Mexico. We're permitting in Nevada, hopefully be producing and building in 2015. And we have this large copper project in the south, and I'd like to talk about all of them. The San Jose mine, this is an aerial view of it. There's about 1,200 employees there. It's a high-grade underground mine. It's been running for several years now. Steady state production, to our credit, 100,000 ounces of gold equivalent annually. On a 100% basis, last year it produced 5.8 million ounces of silver and 84,000 ounces gold. Cash costs are coming in under $800 with a 13-year life. And you can see here the first 6 months of the year in the upper left, and it's on target to produce what's on the upper right. So an attractive cost, reasonable amount of gold, good mine life, and that reserve base has been expanding. The mine next door was bought by, or the deposit next door was bought by GoldCorp, and they're in the process of building a mine. It's called Cerro Negro, right here. And it has always been considered a high-grade gold mine, but when you compare the grade or the amount of mineral per ton, when you look at ours, we're 7 grams gold per ton, they're 8.8, so they're higher grade. Our silver grade is 457 grams per ton, theirs is 62. So on a per ton basis, our grade is 50% higher than theirs, and our property package is at least 40% bigger. Not to say it's all mineralized, but it's a very prospective area of the world. In Mexico, we have made 2 gold pours recently, just starting production at a place called El Gallo, Phase 1. It was an area that was previously mined, first underground, and then in the early 2000s, open pit. It closed in 2005, shortly before we bought it. And we put this into production. It was a very low-cost CapEx, $15 million. On an annual basis, expect to be producing 30,000 ounces a year at $800 cost. Phase 2 is another deposit about 5 miles away, looking to produce from it just over 5 million ounces silver. Converted into gold is 105,000 ounces gold. Capital cost of $180 million, and again, a very attractive cost right now, $600. One of the deposits we'll mine in Phase 1, I bring it up because there is some potential. It's, this particular deposit has about a little over 100,000 ounces of gold defined in it. We've been drilling around it, so I'll just orient you. This red is showing where the mineralization has been identified. This area over here is a modeling of where we would put an open pit or quarry. And we've been, as I said, I'm a big believer in exploration, so we have a fairly aggressive exploration budget. And in June, we put out a press release. We had some drill intercepts of zinc, lead, gold, and silver, which surprised us, sitting just on the, the edge of the pit. And just over here. And then, then we announced some gold, which were good grades, anywhere from 20 to a little over 40 meters of 1 to 2 grams gold that could be mined open pit that were outside of our resource. And just today we announced we found some more zinc. And these aren't small intercepts, they're 41 and 34 meters. It'd be running better than $200 an ounce, or $200 per ton value. So about 0.3 grams per ton gold equivalent. And then coming up with intercepts running anywhere from 18 meters to 77 meters, making it some of the longest intercepts we've seen. And in this resource, the intercepts are about 20 meters in length. So we think there's room to grow that deposit and extend the mine life. The Phase 2 is 5 miles away, and this is just a shot of the topography. It's not that steep. Feasibility study done earlier, well, in September. You can see 5.2 million ounces a year of silver, cost $10 an ounce, $180 million to build, and building in 14. We have another property in Nevada called Gold Bar. Looking over here is an area that was mined in the 80s by Atlas Minerals. They went bankrupt due to a Superfund site in Utah, mining uranium. And we've said, well, let's look at putting it back into production. It's a simple heap leach, very typical of Nevada, single stage crushing. CapEx is 53 million, 50,000 ounces a year production. We're waiting on the Bureau of Land Management to give us permitting, which we expect to receive in 2014. And you can see the economics of this deposit. At $1,300 gold, it would pay back in just over 2 years. And this is just showing our forecast growth and the composition of our growth. Now I'd like to talk about the copper, which currently is subject to a lawsuit that will be heard in, starting in November. We don't think it has any merits, but you never know what happens to lawsuits. But the deposit is 2.3 miles in length by just under a mile wide as we currently know it. It contains 15.4 billion pounds of copper. There was a study done earlier this year by a company called Fraser McKenzie, a small institutional boutique, and they surveyed all the undeveloped copper deposits in the world and looked at Los Azules, ours, and found it to be having the highest grade. High grade is good from an economic standpoint. In terms of resource, it would be the 7th largest at 15.4 billion. Life of mine production, 375 million pounds a year, based on a preliminary study, giving it a 25-year mine life. In the first 5 years, it's projected to produce in excess of half a billion pounds of copper a year. Now, this is a very large capital project. This is just under $3 billion to build, far bigger than our balance sheet. And our plan is to continue exploring to see if we could expand it and either joint venture or sell and fund our growth with the proceeds. So the Los Azules project, what we're just showing is an outline here of the deposit with the high-grade zones in red that are close to surface. That would be the first mine, and that's greater than 0.7 of an 7% copper, which means 14 pounds per ton. Some of the intercepts we've been having, very long intercepts, drawing your attention, the upper right, 1% copper over 216 meters, just over 1% over 236 meters, just less than 1% in the bottom of a hole where we were drilling on a target that we weren't able to penetrate much deeper, but will be this year. And we feel that in mining, when they say something is open, it's saying that the deposit has potential going in these directions where we'll be drilling this year. And this is just showing a cross-sectional view of part of the deposit. This would be the surface. This is a drawing of how the open pit, how the contour of it, and these little squares in different colors denote the ore blocks. And down here, there's been no drilling to the left or to the right, which is one of our exploration targets for this year. Another section, there's some obvious areas that haven't been tested, such as over here to see if there's mineralization sitting on that side. And then outside of all of our projections is a property that we have in Nevada that's been around for quite a number of years. It has about 2 million ounces of gold defined on it in all categories of resources. And when it's defied development because of the nature of the ore. It requires a secondary processing, and at a grade of 1.4 grams was never, there didn't seem to be a way of doing it. But something has happened in Nevada in the last few years that has made it worthwhile revisiting. And that is, 10 years ago in Nevada, power prices were going up, and two big producers there, Newmont Mining and Barrick Gold, wanted to contain their power costs, and they both decided to build power plants. So now there are three major sources of power in Nevada, and prices have come down from 13 and 14 cents per kilowatt to 5-6 cents per kilowatt, allowing us to look at scenarios of ultrafine grinding. And hopefully by the end of this year, we'll have some studies back that'll tell us if it's worthwhile putting this into production as well. We don't have any debt, so no burden on our balance sheet. Our management team, most of them are half my age. They're quite talented, and they have the right attitude. As I said, I came out of the investment industry. I moved into the mining industry, and I found an industry that was mired in inertia, that didn't question the norm, that said, well, this is the way it is, and I said, it doesn't work that way. So we brought in technologies from other industries and applied it to this, and found we could take an old industry that was slow, lethargic, and make it much more dynamic. And this management team has the right amount of impatience and desire to do it now. Catalysts going forward, we're going to need some money, and so we're doing a rights issue, which I'll talk about in a moment. We're maintaining an aggressive exploration program. We expect the lawsuit to be resolved by the end of the second quarter of next year, and we have the permitting and build of El Gallo 2 to look forward to in the next year. So, reasons to think about McEwen Mining: very large shareholder. Our strategy of putting the two companies together in January was all about taking one company with cash flow and no pipeline of development projects, and another company with no cash flow but a development pipeline, and putting them together and being internally financed. That was going well until Argentina came along, the government of Argentina, and started putting some restrictions on getting cash out of the country from operations. Some of that has changed. It's improved and modified since earlier this year, but it's still an issue. Our second source of cash flow is starting up right now in Mexico. I like the growth profile. We trade about 4 million shares a day over the last 12 months. And in terms of opportunity, there's not a lot of coverage on the company at the moment, but we're performing well. Year to date, these are some of the popular junior intermediate gold companies. McEwen Mining is the gold line. So in year to date, we're doing reasonably well. In the last 90 days, we've outperformed all of them. And in the last 30 days, we're still within the mix. So looking at our working capital, the cash we're going to need going from the first quarter of this year, this blue line defines what our cash needs are going to be. So you can see we're turning negative in about 14. We'll need some money, beginning of 2014, and get down to a need of as much as $100 million. A lot of that is due to the delay coming out of Argentina. Looked at a couple of scenarios. If the price of gold moves from the base case of $1,700 for gold and $3,200 for silver, that would mean gold at $1,900 and silver at $3,600. We'd need a little less. If our dividend stream resumes from Argentina, which I think there's a reasonable chance of, we'll need a little bit less. And if both of those happen to occur, then we won't need any money at all. Although we probably would want some, because we'd have almost zero in our treasury. So this is looking at some of our timelines, the construction of our phase 1 in Mexico. As I said, we're going to do a rights issue. It's going to be $60 million. It will be announced in the coming weeks. Then phase 2 kicks in here. We're raising this money to put down payments on our long lead time capital items. Down here is just the CapEx for finishing that project, then Gold Bar kicking in here in Nevada. I said a rights issue. I've long wondered why more companies haven't done rights issues. It seems that you can go out and do a bought deal with strangers. I'll call them strangers. They're non-shareholders. And do it overnight at a big discount to market, and none of your shareholders or few of your shareholders get to participate. And I thought that our securities regulators should make it such that a rights issue could be done as fast. I mean, after all, your shareholders have invested in the company. They must have some knowledge of the company, and yet we can sell to strangers overnight and they don't have any information on the company. It seems somewhat perverse. So the rights issue we're doing will allow us to go. It'll take us to the beginning of 14 or so. And I think in between there we'll have some other sources of capital. But it's going to be $60 million. I'm personally backstopping it, not receiving a fee for that. But so at a minimum, I'll be putting another $15 million in. And if no one wanted to subscribe for it, I'd be putting another $60 million in. It's going to be attractively priced relative to the current markets. And I do think it'll be well subscribed. So McEwen Mining, if you go on Bloomberg's or Reuters, you might get some confusing information. There are two classes of shares. The first class is the common, MUX, of which there are 183 million. And then there's an exchangeable share that was created when we merged. McEwen Mining is a Colorado incorporated company, and when we brought the other company in, Minera Andes, it was a Canadian company. So the exchangeable shares were created to provide a tax deferral for a period of 10 years for the Canadian shareholders. Otherwise, they would have realized tax at the moment of the combination. So the exchangeable shares convert on a one-for-one basis into the common. And there's a 9.5-year sunset on that where they will be converted. So 268 million shares outstanding. There's another 5 million shares in options and warrants. And you can see our market cap's 1.2 billion approximately, with 400 million or 4 million shares a day trading. I urge you all to look at gold if you don't have any in your portfolio. I own gold, both bullion and a reasonably large investment in this company, and in I believe the sector, the junior sector, can deliver oversized returns, and that's certainly why I put my investment here. Thank you very much.